Hi, Mike Flores here, co-founder of Trade Prosper, and welcome to Section 4. In this section, we're going to talk about using price and moving averages to profit. And we're mostly going to focus on the medium and short-term moves in the market. Now, I really like this because it's a simple and powerful way to use moving averages. So for those of you who say that you lack time, and that's a major factor why you don't want to invest or trade in the financial markets, here goes a simple and effective way for you to do so. And there's some benefits here because it's very simple to execute. It doesn't take a lot of time to execute. You'll catch the majority of the big moves, and it doesn't give many signals in the year. However, it will give a few more signals than the crossover method, but you'll see why that might be a good thing. So we're going to start off by using the 200-day simple moving average for this entry technique. Now, before we should go to the charts, I just want to remind you what I'm going to show you is extremely powerful, but it's going to be made even more powerful later on when my colleague Billy shows you how to use options with this technique. And you'll see why that'll be an advantage to you. So let's go to the charts. Okay, so what we have here is a chart of the sterling versus the yen. And what I want you to notice here is that we have a pink dotted line, which represents the 200-day simple moving average, and then you have green and red bars, which represent the price action of this market. And we're going to start by talking about how to get in on the long side. So notice the pink dotted line running across here, and notice here on this day is the first day that we close above the 200-day simple moving average. So we close here at 125.69, and we can see the moving average down at 124.75. So on this day, you would buy market on close, and then you have a few ways that you can leave your stop loss. Now let me show you those stop loss options, and then we'll come back to the chart. Okay, so here go our stop loss options, and they're pretty straightforward as well. Our first stop loss option could be the high or low of the bar on the day that price crosses the moving average and closes above it or below it. Second would be the actual moving average line. And third could be key previous resistance or support level. Okay, so looking at the chart, let's look at our first stop loss example. So we said we would buy here, market on close, because the price closed above the 200-day simple moving average. And our stop would be the low of this day. So you can see there 124.64. Now, notice as we go along, we don't get below 124.64 until this day. And on this day, we're stopped out at 124.64. But notice how the market closed at higher above the 200-day simple moving average on this day. You can see there we closed at 125.43 and the moving average is at 124.84. So even though you were stopped out on this day, you would get back in on the long side market on close. And now your new stop is the low of this day at 124.45. So now with that being the new low, notice here how the market just starts trading higher. And then notice on this day, we trade below the 200-day simple moving average, but we don't close below it. But the next day, you can see here this little tick to the right, that's the close level. So we closed below the 200-day simple moving average on that day. So what this means now is that you have now exited your long position from back here. So you got long on this day with your initial stop down here, but the market broke below and closed below that line, the 200-day simple moving average line. So you exit this long position, you get out here. So notice you take a small loss on that trade, but since you close below it, you now get short on this day, and your stop would be the high of this bar. So notice the second day, okay, you stay short, because remember, even though it broke above, it didn't close above the next day. It's the close that matters. So the next day, we go a little bit lower, but we close higher. So now you exit this short position, and now you get long on this day. And now your stop is the low of this day. Okay? So we were long on this day with our stop here. Then when we broke down and closed below this day, we exited that long position and got short with our stop at the high of this bar. 2 days later, we get stopped out and we get long with our stop at the low of this day. So again, we notice on this day we got long, market on close at 125.81. And then over here on this day, we don't go below 125.81, so we're still in. We don't get below 125.81, so we're still in. But this day, the low is 125.68, so we get stopped out on this day. We close below, so we get short market on close, and our stop is the high of this day. What happens on the next day? You get stopped on the short position, but now you close higher. So you get long on this day, and your stop is this low, down here at 126.02. So what happens? Let's proceed. So like we said, we got long here, and our stop is the low of this day at 126.02. And now let's see what happens. As we move along, we see that the price is going higher, which is good, right? Look at that. We're making a bunch of money here. We got long at 127.03, and we're raking in the dough. Market's going higher. Higher. We're trading nowhere near that level, huh? Look at that. This market's taking off. Look at the 200-day moving average. We never go near it again. Look at that. Look at this move you're catching here. Now, but I want to show you where we got long again, so we don't forget that. We got long on this day, November 14, 2012, and our stop was the low at 126.02. Just remember that. Now remember, the next time we're going to exit is when the trade closes back below this pink dotted line. Closes below this pink dotted line. Look when it happened. September 8th, 2014. Literally almost 2 years later. So we held that position for a really long time, and we made a lot of money on this position. So do you see the power of that technique? That simple entry back then in November of 2012 kept us in that position for 2 years. So you see why we had some inconvenience getting stopped out, getting back in, getting short, getting stopped out, getting back into the long side, getting short, getting stopped out, getting back into the long side. But yet we caught the major move in this market, which lasted for 2 years, and we didn't have to do anything. Now, those whipsaws, which is what we call them when we get stopped in and stopped out, they're kind of pain in the butt. And sometimes they can go on for a little while. That's why using options with this technique is super powerful. And again, Billy will show you that in another video. So I've now brought the concept to your attention, and now Billy will teach you how to use options to supersize this incredible technique. All right, see you guys on the next video. Thanks. Bye now.